In this webinar, we are going to discuss momentum indicators. We're going to ask the question whether indicators can warn us about potential price reversals before price does. All this can be done by analyzing momentum indicators and specifically divergences between the reading of the momentum indicators and price itself. I think this is one of the best topics that we usually discuss when it comes to indicators, because when it comes to technical indicators, we have a variety of technical indicators. There's a big, let's say, there's a wide range of technical indicators. Each indicator is designed for a specific purpose. For example, trend indicators will help the analyst determine the trend of the asset, whether it's in an uptrend, downtrend, or if this trend is about to reverse. We have momentum indicators, which are the topic of our session today. These indicators basically evaluate the speed and the magnitude of the move rather than the direction. We have also volatility indicators that will gauge volatility or price swings. We have volume indicators, which reflect how much is being traded of a certain asset. And we have, of course, some indicators which are hybrid, um, basically are used for various goals. Today, we are going to discuss momentum indicators. I'm going to teach you how to analyze momentum indicators, whether when it comes to direction of these indicators, extreme readings of these indicators, and most importantly, divergences. One of the one of the beautiful things about divergences is that it serves as a leading indicator. So the majority of technical indicators are lagging by nature. So they follow the price. They do not predict the price. Why? Because indicators are basically derived from the price. So the value of the indicator is based on the value of the price. So we wait for the price to close, and then after the candle closes, we can calculate the value of the indicator. So most technical indicators are lagging by nature. One of the leading signals can be derived from the divergence between momentum indicators and price action itself. Now, to understand better this, let us start by discussing what are momentum indicators. Momentum indicators are technical indicators that are used to measure the speed and magnitude of the price movement. We are not measuring or we are not gauging the direction, but rather we are looking into how fast prices are moving. If prices are ascending at an increasing pace or descending at a faster pace. These indicators are also known as oscillators because they oscillate, move above and below an equilibrium level. They are plotted below the price chart, not on top of it. So most of the drawings that you see on the chart are basically drawn on the price action itself. So let me take you to the let's make this as practical as possible. Let's make this session as practical as possible. So this is the price chart. And usually if you add indicators such as moving averages, so if you take trend indicators, for example, let's take the moving average, plot it on the chart, you notice that this moving average, this line here, is drawn on top of on top of the candles or behind the candles. Another indicator that is drawn on the chart is the Bollinger Bands indicator. So again, this indicator, you notice how it is plotted on top of the price action itself. We have the Ichimoku as well, the parabolic stop and reverse. All these indicators are basically plotted on top of the chart. When it comes to oscillators, let me remove all these indicators because they are not our topic for today. So this here is the RSI, the relative strength index, which is a momentum oscillator. When it comes to momentum oscillators, they are drawn on a different panel, on a separate panel below the candles, below the price. They are called oscillators because, as I told you, they oscillate above and below an equilibrium level. Now, for the RSI, the equilibrium is at 50, and we have these 70 and 30 values, which I'm going to explain. So, one major difference between momentum oscillators and other trend and other indicators is the fact that they are drawn or placed below the chart, below the price chart, in a separate panel. They help traders understand the strength of price movement, not just its direction. So we are not detecting the direction, whether prices are going up or down. We are more interested in how fast prices are moving up or down. They reveal to us a slowdown in momentum before it becomes clear through price action. They are used to identify extreme levels such as overbought and oversold conditions. Now, the most popular momentum indicators are the RSI, the stochastic, the intraday momentum index known by IMI, and the rate of change, ROC. These are the three main momentum indicators, or the most widely used momentum indicators. Let's start with the RSI, the relative strength index. This momentum oscillator measures the speed and magnitude of price movement by comparing the average gains to the average losses over a defined period. This period is commonly, by default, it is 14 periods. So we take the last 14 candles, and basically we measure the scale of the upward price movement, and we compare the average of the upward price movement relative to the average of the downward price movement. To measure this, we basically compare the closing price with the previous closing price. So we measure the distance between the previous close and the current close. If the current close is above the previous close, then we are witnessing an upward price movement. Okay, so we measure every upward movement, the distance, we average them, and we do the same for the downward price movement. We average the value of the downward price movement, and we compare the upward movement, the average of the upward movement during these 14 candles, to the average of the downward movement again in these 14 candles. The RSI is the formula is a ratio. So because it is a ratio, uh, it is uh, it is bounded. It is bounded, meaning there is a minimum and a maximum. The RSI fluctuates between 0 and 100. 0 is the minimum reading, and 100 is the maximum reading. Since it fluctuates between 0 and 100, 50 becomes the natural equilibrium level for this indicator. The intraday momentum index is another commonly used momentum oscillator, and it is kind of similar to the RSI, with the only difference that it combines Japanese candlesticks with momentum. It combines candlestick analysis with momentum indicators. It is calculated based on comparing upward and downward price movement over a defined period. Again, it is 14 period. Why 14? Because 14 is half a lunar cycle. So the lunar cycle is 28 days. So most momentum indicators, they are short-term momentum indicators. So basically they are calculated based on a period less than 30 and are considered short-term indicators. The difference between the IMI and the RSI is that the IMI focuses on the relationship between the opening and the closing price. So to measure if a move is up or down, we don't compare the closing price of today with the closing price of yesterday. We compare the closing price of today with the opening price of today. This is why it has something from candlestick, because the candle color is determined based on the difference between the closing price and the opening price. Okay, this is the major difference. Again, it's a ratio, so its value, its values are between zero. It's a bounded indicator, so the values are between 0 and 100. And again, 50 is the equilibrium. Another momentum oscillator is the rate of change, the ROC. The ROC measures the percentage change in price compared to a previous period. Okay, it calculates the difference between the current price and the price 28 days ago. It's an unbounded indicator that moves above and below the zero line. Because we are comparing the price of today with the price 28 periods ago, if today's price is below the price 28 days ago, the value of the indicator will be negative. If the price today is higher than where it was 28 periods ago, the value becomes positive. And there is no cap. There is no cap and floor for this indicator. So it is not capped. Okay. It is not bounded. It is unbounded, meaning it can go up until no one knows, and it can go into the minus again without a floor. So the equilibrium level for this indicator will be the zero level. So the equilibrium, or the equilibrium level for the RSI and the IMI is the 50. The equilibrium level for the ROC is the zero level. Okay, no one cares how these indicators are calculated. Everyone wants to understand how they are utilized, how to analyze them, and what are the signals that we can derive from these amazing indicators. So let's dig into this. What do these momentum indicators tell us? Again, this is here the RSI. It is plotted below the price chart. Okay, what does this line tells me? Well, simply, when it goes above 50, the equilibrium, it means that bullish momentum is accelerating. So prices are increasing. So we have more upward movement than downward movement. Okay. And the upward movement is accelerating. When the oscillator moves from above to below 50, it means that the downward momentum is accelerating. Okay? So above 50, we have bullish momentum. Below 50, we have bearish momentum. So as it goes above 50 and towards its maximum, we can say that bullish momentum is increasing. So prices are not only going up, they are going up at a faster pace. Okay. What if it started to drop from, let's say, values around 70, and the value of the indicator started to drop from 70 to 60? What does that mean? It doesn't mean that we have a bearish momentum now. No, the momentum is still bullish, but it is slowing down. So as long as the line or the indicator is above 50, we have bullish momentum. But as it reverses and peaks, we can we can conclude that the bullish momentum is slowing down. So here, let me just activate the laser. Yes, perfect. So here what do we have? Above 50, we have bullish momentum. Bullish momentum is increasing. Bullish momentum is accelerating. It peaks and starts to drop. What can we conclude? That the bullish momentum is decelerating, meaning prices are still rising, but at a slower pace. So notice here how we have big bullish candles, momentum is accelerating. Here, up to this point, prices are still going up, but at a slower pace. When the oscillator goes from above 50 to below 50, we can conclude that now we flipped from bullish momentum to bearish momentum. So now the majority of the price movement is bearish. As it goes below 50, the bearish movement is accelerating. When it bottoms and starts to go up, it means that the bearish momentum is decelerating. So prices are still going down, but at a slower pace. Clear? Any questions about this part? So this is the general reading of momentum. The goal here is to understand the strength of the current move, the magnitude of the current move, and whether it is likely to continue or weaken. Again, I'm going to repeat it quickly. As momentum oscillators go above 50, we can conclude that bullish momentum is accelerating. When it starts to go down and it is still above 50, we can say that the bullish momentum is decelerating. Bullish momentum is decelerating, accelerating, decelerating. When we cross below 50, bearish momentum is accelerating. Bearish momentum is accelerating. Bearish momentum is accelerating. Bearish momentum is decelerating. Decelerating. But we are still bearish. And then once we go above 50, the majority of the price movement is becoming bullish now, and it's accelerating as we go up. Clear? Excellent. Now, how do we analyze these momentum oscillators? Momentum often moves in line with price and can be analyzed in a very similar way to identify a potential shift in direction. So, one thing you can clearly notice when you compare price direction to the direction of the momentum oscillators is that they move in tandem. So they move kind of in sync with each other. When prices are moving down, momentum oscillators are moving down. When prices are moving up, momentum oscillators are moving up. Prices are moving down, momentum oscillators are moving down. Prices are moving up, momentum oscillators are moving up. So they move in tandem, they move in parallel or in sync. Because they move in sync, the same techniques we use to identify the trend of the price, we can use to identify the trend and the direction of the momentum oscillators. So, how do we identify the trend of the price? We use the sequence of tops and bottoms, right? So, if prices are moving in a sequence of higher tops and higher bottoms, we are in an uptrend. We can use trend lines, right, to determine the trend. So as long as prices are below a certain trend line, we can consider that the trend is down. When prices cross above a certain trend line, we can say that we could be witnessing a reversal in the trend. These same techniques can be applied to the momentum oscillators as well. So here I can see a clear downtrend. Momentum, the RSI is moving in a sequence of lower tops and lower bottoms. So I can connect these tops by drawing a straight line. And the moment the oscillator goes above this downward trend line, I can say that, we are witnessing a shift in the direction of the momentum. So here we can see that bearish momentum is accelerating. The moment the oscillator breaks above this trend line, I can say, the bearish momentum is weakening now. And it could be going up to cross above the equilibrium line. Another technique is to use a moving average. The same way we apply a moving average to the price, we can apply a moving average to the oscillator. And I will show you how to apply this on your MetaTrader. Notice here, Prices are moving up, momentum is moving up. What happened here? We have a nice double top. We have a nice double top and then a break below the upward trend line. What does this signals? A reversal in the direction of the momentum indicator, which should be as well followed or associated with a similar reversal in the price. Why? Because price and momentum, they move alongside each other. They move in a similar manner. So when I spot a reversal in momentum, I should assume that a similar reversal is also happening in the price. So why do I use reversals in momentum? Basically as a filtering layer, as a confirmation for a similar reversal in the price. If I see a reversal in the price that is not as well in sync with a similar reversal in momentum, then this could be a warning sign. So we use reversal in momentum readings to confirm a similar reversal in the price. Another technique is to use a moving average. So look here, we added a moving average to the IMI. If the IMI period is 14, usually the moving average should be 7, half the period of the oscillator. Okay, I added a moving average to the oscillator, and as long as the oscillator is below the moving average, we are in a downtrend. When the oscillator goes above the moving average, we can say, a reversal in momentum is happening, and it should be followed by a reversal in the price. And this is exactly what happened here, right? Notice how this RSI was moving in a downtrend below the downtrend line. The IMI was moving in a downtrend below its moving average. But here at this vertical point, what happened? The IMI crossed above its moving average. The RSI crossed above its trend line, and price also witnessed a reversal to the upside. So a reversal in momentum indicators was associated with a similar reversal in the price. Clear? Now, how do we add a moving average to our indicator? You open here the navigator window in your MetaTrader platform. You go to indicators, trend indicators, and you drag and drop the moving average on top of the oscillator. Now this pop-up will appear. Okay, it's a simple moving average period. We wanted 7. Why 7? Because it should be half the period of the RSI. The period of the RSI is 14, so the period of the moving average, I want it to be 7. Apply to, I don't apply it to close, because if I apply it to close, the indicator with the moving average will appear on top of the candles. Look, no, it appeared here. But usually it appeared on the RSI, but it is based on the price. So I want to apply it on the previous indicator's data. This is very important. Notice here how it started to reflect the average reading of the RSI, not the average reading of the price. Okay? So notice here, I can assume that every time when the oscillator breaks below its moving average, I should expect a similar reversal in the price. So here, the RSI, the blue line, went below the moving average, the red line, and at the same horizontal here, look what happened. RSI crossed below the moving average, and you can see that the price started to form a top. If I remove the moving average, So now I don't have a moving average. I don't want to apply a moving average, it's too complicated. Well, simply what you can do is you can draw trend lines. How to draw a trend line? The same way you draw a trend line alongside the tops here. So this is a downward trend line connecting these three tops. Prices broke above the trend line. I can draw a similar trend line connecting the tops of the. So notice here what happened. The price of the indicator started to break above its moving average, above its trend line. Did the price break above the trend line at this zone? No. So yes, the direction of the oscillator started to reverse, but we didn't see a reversal in the price. However, notice what happened here. When price broke above the trend line, this was also associated with a clear reversal in the oscillator. So again, here, the oscillator, what did we see? We saw the oscillator breaking above. At this point here, the oscillator broke above its previous top, and we have a clear reversal to the upside. Now, at this point, the reversal in momentum confirmed the reversal in the price. But we were waiting for this reversal since when? We were waiting for this reversal since this point here, since this point here, when the oscillator broke above its downward trend line. This was our alert sign. Habib, pay attention. The oscillator broke above its trend line. Be ready. A reversal in price could be on its way. The same way here, I can draw an upward trend line across the bottoms that was associated as well with a reversal in the price. Now, prices are moving down. I can delete this one. I can delete this one. I can say, okay, let me connect these tops here. So you see how the oscillator is below the downward trend line. And the moment I see a reversal above this trend line, I can assume that a similar reversal could be happening in the price. So trend lines, sequence of tops and bottoms, all these are techniques that you can use to determine a reversal in the reading of momentum that when it happens in association with a similar reversal in the price, it serves as a further confirmation, and it increases the, let's say, it increases the strength and the reliability of the reversal itself. Any questions about the reversal of or how to analyze the direction of momentum oscillators? If you have any questions, guys, don't hesitate to drop them in the Q&A window. We have the Q&A window where you can drop all your questions, and I'm ready to answer all your questions. Remember, a reversal in momentum direction may signal or strengthen the case for a price reversal. Now, if a reversal in the oscillator took place and it was not associated with a reversal in the price, this serves as an alert, as a warning that you should be ready for a potential reversal in the price. If a reversal in the price happened that was not associated with a reversal in momentum, this is a warning sign not to act on the reversal of the price until you see a potential reversal, until you see a reversal in the momentum oscillator as well. So both price and momentum should follow the same direction. Another way to analyze momentum oscillators is through the extreme readings. We call it the momentum extremes. Now, overbought and oversold condition, these are the extreme readings of the oscillators. Here, we don't care about the direction of the oscillator. Here, we care about the reading, the value of the oscillator. Take the RSI, for example. The RSI, we said it is a bounded indicator that fluctuates between 0 and 100. 0 is the bare minimum, 100 is the maximum, 50 is the equilibrium. So when the reading is 50, 60, 40, it's close to equilibrium, right? So it can move freely. We are not witnessing extreme readings. But as the oscillator, as the RSI climbs closer to its maximum, then when it is close to the maximum, we can conclude more signals. It provides us with more reliable data. Okay, because it is a bounded indicator that fluctuates between 0 and 100, 50 is the equilibrium. Now, what is the extreme or the upper bound? The upper bound is anything above 70, and the lower bound is anything below 30. So when the RSI is between 70 and 30, this is called normal reading. When the RSI crosses above 70, it signals that prices are overbought. There's too much buying taking place. Prices have been going up at a speed that is not sustainable anymore. So overbought means that prices has been going up at a pace that is not sustainable. It doesn't mean that prices cannot keep going up. It doesn't mean that we must see a reversal in price. No, but it is a warning that prices are extended now. The upward move is extended and a correction is due. Not again, is due, but there is nothing that guarantee this correction because strong trends can remain in overbought and oversold zones for extended periods. And this reminds me of my first ever trade that I did, and it was a losing trade. Okay, when I joined the dealing room in 2008, one client called and he wanted to buy the Dow Jones. You know, in 2008, what happened? Yeah, the financial crisis. So all the indices were going down. It was a negative year for the markets. Stocks were going down, but he wanted to catch the bottoms. Okay, this client was trying to catch falling knives. So he sent an order to the dealer. He called the dealing room. I was still in my early days. I picked the phone, and the guy said, "Habib, please buy for me one Dow Jones futures, one contract." And by mistake, I bought two. Now, what's done is done. It's a mistake. Usually, when you do when you do a mistake, when you open a position by mistake, you either have to close it during your shift or you close it immediately. So either you close the mistake immediately or you can hold it till the end of your shift. And of course, we have some risk guidance or mandates that we can maneuver around. So my superior at that point said, Habib, no, look at the RSI. The RSI is oversold. So at any point, the Dow Jones could reverse to the upside. And for me, to my knowledge at that time, I didn't know much. So I listened to his words and I kept the position open. Now, from a loss of $40, I was forced to close the position with $800 loss at the end of my shift. Why? Because although it was oversold, it was below 30, it kept dropping, it kept going down, but at a slower pace, but it kept going down. So the position kept losing money. And although I closed the position at the end of my shift, I continued to monitor the Dow Jones index the next day and the day after. And you know what happened? It kept going down, and the momentum oscillator started to go up. Price was dropping, but the momentum oscillator was going up. Why? Because prices continued to drop, but at a slower pace. So let's say Monday, the Dow Jones dropped 200 points. Tuesday, it dropped 300 points. Wednesday, it dropped 500 points. You notice 200, 300, 500. If on Thursday, the Dow Jones dropped 100 points, what will happen to the momentum? It would be going down Monday, Tuesday, Wednesday. But on Thursday, because it only dropped 100 points, you will see that the momentum starts to go up. It's still below 50, but it is moving up. Why? Because the descent is slowing down. Prices are still dropping, but at a slower pace. This is exactly why we say the bearish momentum is decelerating. And at this point, I learned a big lesson, which most beginners do commit, falls for. They see momentum oscillator above 70. Oh, it's overbought. We should short. They see momentum oscillator below 30. Oh, it's a good time to buy. No, it's not a good time to buy. Actually, it could be a good time to exit your short positions. And when it goes above 70, if you have a long position already, maybe it's time to play defense and start to exit your longs. But definitely, it's not a sign to short the market, to enter a new sell position. Clear? This is the extreme readings. So usually traders use overbought and oversold signals to exit positions or not to enter, to avoid entering new positions. So I see momentum here above 70. I see RSI above 70. I have a buy signal. Maybe I don't take the signal. I will not act on this signal. I will not enter a buy position when momentum is above 70. This is the right way to use extreme readings in oscillators. Now, the best way to analyze momentum oscillators is not direction, is not extremes, is divergence. Divergence happens when there is a mismatch between price and momentum. You remember what we said in the beginning of our session? Price and momentum move in tandem. They move in parallel, in sync. Now, when they start moving in a different way, this is what is known as divergence. Divergence occurs when price and momentum move differently. It may reflect a gradual weakening in momentum. It is considered as an early signal of potential price reversal. Early signal of potential price reversal. Why? Because divergence happens before the price reverses. That's why it is a leading signal. It is not a confirmation on its own and requires context and supporting analysis. Let's see what is a divergence. We will start from the classic bullish divergence. A classic bullish divergence occurs after a downward price movement. So, prime first prices will be going down. Price forms lower lows. Notice here how prices are moving with lower bottoms and lower tops, lower highs, lower lows. In the normal case, what should the momentum oscillator be doing? It should also be printing lower lows. However, in the a momentum indicator fails to form a lower low. Prices form lower lows, but the oscillator fails to form lower lows. This indicates weakening bearish momentum, often appears after a prolonged decline. Notice here prices are moving down, 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 down. Momentum is moving down, 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 not anymore. Momentum is weakening. It is not following through the price. So when prices form lower lows, the oscillator fails to form lower lows. This is where the divergence is happening. This is a bullish signal. Although price continues to decline, sellers are gradually losing strength. Usually, when this happens, it could be a sign that a potential reversal in price is about to take place. Let's go to our platform to see an example of this bullish classic divergence. So here prices are moving down. Yeah, if you take from this point here, you can see prices are going down, up, down, up, down, up, always lower highs, lower lows, lower tops, lower bottoms. When it comes to the oscillator itself, here I have a top. We always compare price and momentum at the same horizontal level. Okay? So if I'm comparing this top here, when I'm comparing this top here, let me move it a little bit. When I'm comparing this top here, when I'm comparing this bottom here, I'm always looking at the momentum and the price along the same horizontal level. So this top here, this top of the oscillator. This is the top of the price. This is the top of the oscillator. Same vertical level. But what do you notice here? This top is lower than this top. This top is lower than this top. This top is lower than this top. Let's look at the bottoms. Next, let's look at the bottoms. What do you notice here? This is one bottom. This is one bottom. Notice here what happens. This is another bottom. This is another bottom, lower than this. This is a lower bottom compared to this, but the momentum oscillator failed. So if I am to draw a line between this bottom and this bottom, I can clearly notice that this bottom is lower than this low is lower than this low. But if I compare the momentum, it is failing to follow through. Prices moved to lower lows, but the oscillator failed to move in a similar manner. This is a classic bullish divergence. What happened after this classic bullish divergence? Prices went up. So here I have a classic bullish divergence, and then I have a break of the trend line. Notice how prices broke above this trend line. So here is the right time to act on the signal. You can buy, place your stop loss below the low, and so on. But the warning sign came from what? From the divergence between the price and the momentum oscillator. Now, classic divergences are used to determine reversals against the trend. Okay? So they are used to determine, to help the trader in picking bottoms and picking the tops. Okay? Everyone wants to buy at the lowest point. Everyone wants to sell at the highest point. How do you do that? Divergences can help you in picking the bottoms and the tops. It gives you a leading sign that a potential bottom could be in place. A potential bottom is forming. a potential top is forming. This is the classic. Okay? It helps you to determine potential bottoms and tops, but you should be aware that you are trading against the trend. Because notice here, the trend is down, prices are dropping, and you are trying to catch the bottom. This is very risky. But for those brave ones that wish to do so, momentum divergence is one way that can assist you, is one technique that can assist you. Prices drop to a new low, momentum fails to drop to a new low. This is the definition of a classic bullish divergence. Now, what about the classic bearish divergence? Well, it's the opposite. It happens after a prolonged rally. So prices will be moving up, moving in an uptrend. Price forms a higher top, but the momentum oscillator fails to form a higher top. So notice here how price is moving in an uptrend, oscillator is moving in an uptrend. This top is higher than this top, this top is higher than this top, this top is higher than this top, this top is lower than this top. This is the divergence. What could happen here? A drop. Let's go back to the same example that we were using before. Notice here in this rally. Notice here in this rally. Prices are moving up, yeah? Higher tops, higher bottoms. The oscillator is moving up, higher tops, higher bottoms. What happened here? Between this top and this top is higher than this top. What happened to the oscillator? At the same level. Okay? At the same level, I will not take it as a divergence. But notice what happened here. Notice what happened between this top and this top. Between this top and this top, this is clearly above, but the oscillator here is clearly below. So I'm going to delete this one. And I'm just going to focus on the last divergence here. Notice how prices went to a new high, but the oscillator failed to print a higher high. What happened after? Boom. It was the end of the uptrend and the beginning of a new downward move. So notice here how the bearish divergence predicted the end of the rally and the beginning of the downtrend. And notice here how the bullish classic divergence managed to help us identify the end of the downtrend and the beginning of another move up. Both against the trend, because here we were selling and the trend was upward. It's very risky. And here it gave us a buy signal, but the trend was bearish. That is why I don't like a lot classic divergences. I prefer hidden divergences. What is a hidden divergence? A hidden divergence allows us to trade with the direction of the trend. In a hidden divergence, the indicator. So let's start with the hidden bullish divergence. Price forms higher lows. Here we have an uptrend, higher tops, higher bottoms. So we are in an uptrend, price is correcting lower. It reaches a point where it is above the previous bottom, so higher low. The indicator goes below the previous low. So notice here how we have bottom, top, higher top, bottom, top, higher top. Price drops. It is still above the bottom, but the indicator drops below. Hidden divergence is linked to a continuation in the trend. I love it because you are trading with the direction of the trend, not against the trend. You are trying to pick the bottom that will allows you to trade a directional move with the existing trend, not go against the trend. You are buying and the general trend is up. It gives you a signal that confirms the direction of the trend, not oppose it. I'm going to take you to the same chart again to show you a hidden bearish divergence. But let me explain the hidden bearish divergence first, and then we will have an example on it. So this is the hidden bullish divergence. It allows us to trade an uptrend after a correction and allows us to benefit from the upcoming upward move. The hidden bearish divergence occurs in a downtrend. Price forms a lower top, a lower high. Look here, it's a downtrend. We have a correction up. Prices did not cross the previous high. The indicator went above the previous high. So here, look, lower top, lower bottom, lower top, lower bottom, higher top. Whereas price is still moving in lower top, lower bottom, lower top. It still didn't break this level here, but notice how the indicator went above the previous top. This is called a bearish hidden divergence. Going back to the silver here chart, we are moving in a downtrend. Okay, we are moving in a downtrend. What happens? What happened here? Top, lower top, lower top. When it comes to the oscillator, we have top, lower top, higher top. I'm going to draw a line. I'm going to remove these lines just to simplify things. And I'm going to draw a new line comparing this top here with this top here. Notice how price is below the previous top. And notice how this top here is higher than the previous top. What does it mean? Although momentum is accelerating, prices are not following through. So momentum reached new high, but price did not reach a new high. And here I have the opportunity. So what is the signal? That this upward move could be reaching a peak. The trend is down, the correction is going up, but it is approaching an end. So here, what do I do if I am a trader? I would wait for any reversal sign in order to short the market. And look at this consolidation zone. Look at this consolidation zone between these tops and this bottom here. And look at this bearish candle. When it broke, what happened? Prices dropped. So this, the warning sign came from the hidden bearish divergence first. Let's see if we can see another example. So looking at this upward move here, prices broke to a new high. The indicator failed to reach a new high. This was the end of the upward move and the beginning of a new downward move. Look here, prices are dropping new lows. Prices are dropping new lows. The oscillator made a higher bottom, the end of the downtrend and the beginning of a new upward move. Notice here what happened. We are in an uptrend. Okay, here we are in an uptrend. Prices are moving up, up, up. Prices are dropping. This is a bottom. This is a bottom. Prices are above the previous lows. The oscillator went and printed a lower low. So higher low in price, lower low in momentum. I have a big green candle. This is my confirmation of the beginning of the upward move. This is a confirmation of the beginning of the upward move. So this is a sign that prices should go higher. Clear? Our time is up, but please, if you have any questions, do let me know. Now, sometimes divergences do fail because we are not using them in the right way. Using divergence against a strong trend is not a good idea. Ignoring market structure and broader trend is not a good idea. Entering too early without confirmation is also one of the big mistakes that traders do commit. Treating divergence as a standalone signal is also not good and not advisable. And confusing weaker momentum with a full trend reversal is also a big mistake. Now, when you look at the broader context, you should focus on market trend, focus on support and resistance levels, liquidity zones, and always follow the news and the expectations regarding any fundamentals that are fundamental events that are taking place, economic releases. These do move markets, and technical analysis cannot stand in the face of change in fundamentals. Okay, economic changes do lead traders to change their minds when it comes to deciding whether to buy or sell. So when new information is released, expect that this could lead to new decisions by buyers and sellers that will then be reflected in the price. When it comes to price confirmation, you can wait for a reversal candlestick to form in the direction of the signal that you are getting from momentum. You can also wait for a break of the pattern high or low, or just confirmation from price action itself. Remember that divergence should support the analysis, but should not replace it. Um, and that's it. Classic divergences highlights weakening momentum before a potential price reversal. Hidden divergences allow us to trade the continuations of a trend rather than the reversals of the trend. Context and confirmation are essential part of the analysis, and indicators are used to support price action, not replace it. I hope you joined. I hope you enjoyed this session. I tried to make it as practical as possible. Now, I just want to take I just want to take the time to remind everyone that um, trading is done by is learned through practice, not theory. So everything that you learned today, try to apply. If not on a real account with a small amount of money, on a demo account, open a demo account, test these strategies with virtual money before risking your own, and always attend our webinars because we will continue to provide you with these educational material and knowledge to help you become a better trader. Thank you very much and looking forward to see you in our upcoming webinars.